We tend to think as Canadians that the banks have our back, but let's not joke about it. They're the most profitable companies in the country with literally billions and billions of dollars quarter over quarter. Their number one mandate is not to be your best friend and save you money, it's to get the most. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. All right, ladies and gentlemen, welcome back to another episode of What the Heck Did the Government Do to Change Lending Rules and Real Estate Guidelines this week? That's right, we're back with another change a week after a bombshell was dropped around CMHC maximum limits and amortizations with another rule change. And it's a bit of a doozy, not only because, well, it's a good change and a positive change, but we don't have all the different details like always. And, well, we don't know exactly how it's going to impact the market, but I can tell you this is a rule change that the Mortgage Brokers Association has been screaming at the top of their lungs for the better part of the last 5 years, maybe at least 5 years. So let's break it down. But before I do, not only was the ball dropped as far as the CMHC guidelines or the news dropped, but on top of that, the same week, the BC NDP announced a Homebuyers platform. Of course, if you're in a different province, this doesn't affect you, but it'll be curious to know if other provinces follow suit in regards to their potential home and construction and building challenges and getting homebuyers in the marketplace. Anyways, BC NDP just dropped a new homebuyers program, followed by a massive promise if they get elected for the upcoming BC election for all first-time buyers in the country. As you can probably imagine, a lot of the details are still a little bit sketchy about the second program, but the first one is interesting. We know the details, and I'll break down what we know, and you can decide whether or not you think it's good or bad. I'll give you my feedback and thoughts on it. So let's get into the OSFI changes. A week after the government stepped in and made the change with CMHC guidelines. Well, if you don't remember what those are, it allows buyers now to use CMHC backed insurance, less than 20% down purchases primarily, up to now just a penny under $1.5 million. That was significant, and it reduced the required down payment amount from $300,000 to $125,000 for that just about $1.5 million purchase point. And if you don't remember, first-time buyers now have the ability to do 30-year amortizations on all products, as long as on all properties, as long as they're qualified by CMHC after December 15th, which is when all of these new rules kick in. Oh, and don't forget, anybody using CMHC or with less than 20% down can now do a 30-year amortization on a new build property. Well, a week after that happened, they thought, well, let's bring some more noise to the marketplace. And let's go ahead and do something that they've been screaming about for a long time, which is kicking the stress test to the curb. That's right. Now, let's talk about this for a second and what exactly I mean. Uninsured switches, where people who are coming up for renewal are looking to switch their mortgage and keep it the same over to a new institution for a new product or program, or just to be with a new lender, or maybe get a different interest rate. Well, the market has opened up, and now borrowers do have the ability to do so without having to qualify over the stress test. Call this a common sense change, and one that's a little bit too late. This should have been available in 2023 when rates were hitting their highs in the 6 to 6.5% range. That would probably have been the time that would have been most helpful. But you can consider this preparation for the upcoming quote unquote renewal crisis, which is supposedly coming between 25 and 2026 in the marketplace, to help people have more affordable options when it comes to their mortgage needs. Now, let's break this down and talk about specifically what exactly happened and why it's a big deal. So, first and foremost, the changes are going to take effect on November 21st. So that's November 21st of 2024. For anyone looking to submit their mortgage application for renewal, so if you're coming up for renewal, that's a date that could be impactful for you if you have an uninsured mortgage. Now, an uninsured mortgage is one that is either over 20% down, over $1 million purchase price, could be a 30-year amortization originally or now, a rental property, it would have been a refinance at some point before that. In any of those circumstances, that mortgage was no longer insured. And so up until I guess November 21st of this coming year, if you wanted to switch lenders, you had to qualify to switch your mortgage product to another lender at 2%. That's 200 basis points above the rate you're getting, which seems crazy because for a well qualified borrower who's proven that they've been able to make their payments, you've essentially up until this point said you can't go to any other lender unless you can qualify at a payment which is significant. Like in let's say a $700,000-800,000 monthly payment, that could be the equivalent to an extra $1,000 that they have to show that they can actually make payments on if they were to switch lenders. So a straight switch, just to be clear, is one where everything, technically speaking, remains the same. So you're either on the same amortization schedule. Now there are some exceptions whereby you can go back to the original amortization, but for the sake of our conversation, you stay on the same schedule. You haven't really changed the loan amount, although some lenders allow for up to $3,000, and you're just switching lenders for a better rate or product or term, or you just don't like the bank that you're with at this point right now. This is notable. Now, there's been a lot of confusion already in the marketplace to suggest that, okay, well, now I don't need to qualify for a stress test if I want to do a refinance, or maybe I don't need a stress test if I'm getting an uninsured mortgage. Unfortunately, not the case. That's not the case. This is basically for people who have mortgages. They've proven that they've been able to make those payments for 1, 2, 3, 4, 5 years, and they just want to switch over to another lender. So why did OSFI make this change now? Well, I mean, again, aside from the obvious of the fact that at this point they see this quote unquote debt cliff coming. And of course, you can argue that the government is influencing this decision because of the upcoming elections. The reality is they're looking at balancing the playing field, if you will, because up until now, if you had an insured mortgage, you could switch over to another lender, or you can switch over to another lender and still qualify for great rates in terms of products. But with the uninsured option, the reality is a vast majority of people who took those uninsured mortgages, which was a significant part of the database, I don't have the stats on that, a significant part of the population, I mean, and I don't have the actual stats. Those people would have no option pretty much but to stick with the bank and whatever they're willing to offer, or that's it, renew. That's no options if you can't qualify with that stress test. Now, the crazy thing is that, again, brokers and our associations have been screaming for this for a long time because it's a very low risk option that helps consumers, and anything that helps consumers and creates or anything that creates competition is what helps consumers. And the reality is this is going to put the banks on notice, or the lenders on notice, that people can and will leave even if they've been making their payments, because they now have more options available to them, at least from the ability to move. They're not squeezed into that same lending institution. The sad reality is lenders also know, or did know up to this point, predominantly the banks, if someone would have the ability to be able to go somewhere else. You best believe they're looking at that application and saying, well, if things are the same here, chances are these people are not going to leave our institution and go somewhere else. And for that reason, there weren't very many competitive offers available for people. Now, fast forward into 2024, we've seen rates come down nearly 1.5% from the peak. That's right, 1.5% from the peak at this point right now. And people are now in a position where banks have been actually quite competitive on offers, but it hasn't been for everyone. We've seen that well qualified borrowers, those who could potentially leave, those who might want to leave, are getting offered sometimes exceptional terms that can't be found anywhere available in any market. Whereas those who might be in a little bit of squeeze or bind are not getting offered fair solutions, or just getting left in the dust. This is, again, great news for people coming up in 2025 and 2026, because the banks are going to get so busy that there's going to get people who are just honestly left behind. And to go on a little bit of a side note, I've spent the last year developing a software, maybe more than this, developing a software where we can actually track these numbers, track a client's renewal, track their upcoming dates, show them where the opportunities to renew is, show them where the interest savings are, and much, much more. In any case, back on track at this point now. If you think if I'm doing that, the banks are definitely on top of that, and they know that the vast majority of people do not shop around at renewal, and at most they'll typically ask for a discount one time. And so, anyways, this is just a more of an incentive for consumers to start looking at other options. Like, let's just look at the numbers here for a second. So imagine if you are switching a $300,000 mortgage over to another lender right now. Like right today, you'd have to qualify with about $81,300 And that's, again, just a general guideline. There could be a higher or lower, depends on your situation. Now, without the stress test, you'd need only $71,000 of income. That seems pretty plausible in terms of an income situation that someone could earn, maybe around that amount. In any case, that's $12,000 less income required to show, which is over 12.7% less. And let's say that the other lender was willing to offer better rates or terms, anywhere between 0.05 to 0.25% better. Maybe there's something else of this going on in the product. Well, that could be the equivalent of $1,400 savings on just that $300,000 plus more, depending on what the strategy is that they take. And that's a minimum situation. So looking at that consideration and kind of looking at the context of this change, it's going to create more competition. It's going to create more opportunities. And at the end of the day, that's good for consumers. Now, there's some unanswered questions around whether or not those new lenders, how they will qualify the mortgages in terms of rates and terms, what they can offer, what they can't offer. Is it just an uninsured option? Will this allow the non-bank lenders to enter the space to make it more competitive? You best believe that would be best for everyone to see some of the monoline lenders enter the space, especially from a rate perspective. Again, we tend to think as Canadians that the banks have our back, but let's not joke about it. They're the most profitable companies in the country with literally billions and billions of dollars quarter over quarter. Their number one mandate is not to be your best friend and save you money. It's to get the most amount of money out of you possible. And giving you a one-time discount on your mortgage is the easiest way for them to get in there, between the cashbacks and, we'll give you a discount, and you're going to forget about it. That's what most Canadians do. Again, this is another reason that Canadians should be looking for a way to work with someone who monitors these types of things, so that at renewal time they're not left in the dust and they do have options. Now, looking back at the different changes from CMHC and OSFI, again, in the beginning, I wouldn't blame you if your head is swirling between all the different changes that have gone on in the last year federally, CMHC, OSFI. I mean, it's just been absolutely crazy. And the beginning of this whole circus started in 2015-16 when CMHC changed the guidelines around insurability, which effectively created a whole whack load of different types of lending guidelines. And that's why an interest rate for a mortgage with less than 20% down versus one with a 30-year amortization called an uninsured mortgage is typically a spread, which is the difference in rates, of at least 0.5%. That's massive. That's huge. And so to level the playing field here is a benefit to all consumers and a win for everyone out there. So some of the questions, again, that we need to get answered, we need to know the answers to, are really, how is this going to affect the other lenders? Are they going to be able to compete for your mortgage? Are they going to be able to offer lending solutions and rates and terms? What is that going to look like from an insurability perspective? And at the end of the day, we're grateful for OSFI for actually doing something that they should have done a long time ago, but they're doing at this point right now because it is to the benefit of the consumer, which is, in my opinion, always a good thing. Now, before I'm going to move into this NDP conversation and then circle back to the conversation from last week around 30-year amortizations, if you're watching this or if you're on the podcast listening to this, I would love to hear your feedback on these changes from CMHC and OSFI and what you think this means for the market, specifically as it comes to switching your mortgage. If you have a mortgage right now, are you going to shop different lenders? And if so, are you going online? Are you going to a broker like myself? Are you going to different banks? Like, how are you shopping for a mortgage? I'm genuinely curious as to what your thoughts are, because it helps us to understand the impact for the average consumer and really how to explain things. And I'll break that down in a future episode depending on the responses. All right, so number 2, let's talk about this quote-unquote groundbreaking opportunity that the NDP announced just a week and a half ago for British Columbians and what it looks like for Vancouver first-time buyers. Now, forgive me in advance, please, because if my pronunciation of these different First Nations bands is incorrect, I'm working my best at it. There's a partnership right now between BC, Vancouver, and multiple nations. That would be the Musqueam, Tsleil-Waututh nations, and obviously BC, as you mentioned, to offer about 2,600 homes through what they're calling an Attainable housing initiative in the Heatherlands in Vancouver. So obviously, if you're not in Vancouver, this isn't impactful. But even if you're not in Vancouver, you should listen to this, because it'll be interesting to see if different cities and different areas follow this same initiative for basically government incentivized home purchases. Now, I'm kind of conflicted about how I feel about this at this point right now, because the reality is it's letting people own homes, but you're basically eliminating a big chunk of the potential value. And listen, it's not a grant, it's a loan that the governments are taking out giving you in order to get into the real estate, and you have to repay back this equity afterwards. So basically, we're proposing about 2,600 homes in an 8.5 hectare site between West 33rd and West 37th Avenue in Vancouver. Again, if you're in a different city, this doesn't impact you today, but think about this could impact your marketplace. They're going to be doing studios, 1 beds, 2 beds, and 3 beds. And the market prices for these units range as of right now from 372 grand to $900,000. Now, according to the Vancouver guidelines or the research from this article, the studio prices should start based on Vancouver prices from 620 to 1.5. And so they're suggesting that they're providing a 60% of market pricing on brand new units for people purchasing these units that actually qualify. What's more so is when they launch this program, there's only going to be a 5% deposit. But here's the thing, this is a 60/40 financing model. And in my breakdown here, here's what I've learned. Number one, the borrower or the buyer owns the home outright, sort of. And they initially finance and pay for just 60% of the market value. The province is owning the remaining 40%, which is repaid when the home is sold over 25 years. So you got to own that home and it gets repaid over 25 years. The initiative, now the home itself, if it's sold, it pays it back, or in 25 years, it's wiped out somehow. It only applies to first time buyers. So only first time buyers, which is crazy to think they're reserving 2,600 homes in a brand new community for only first time buyers. I'm just genuinely curious about the dynamic of what that might look like, especially from a strata perspective. Just thinking back to, people who are buying their first property are probably not as familiar with running a strata or being part of a strata and what that could look like. And I know that's just a kind of a tangent, but just some general thoughts right here. The whole idea is to help out middle income earners in Vancouver, as what they're quoting it right now. And the timeline that we're providing is basically 2025 construction beginning, which is next year, with prospective buyers being able to register as early as spring of next year. The stats basically they're suggesting right now is that the province is contributing 672 million towards this project, and they expect to recoup all of that when the buyers repay back the 40% financing somehow. So I mean, interesting. Downsides, it's on native lease land, so it's negatively going to impact the value of the property now and in the future, negatively going to impact financing. It's a lot of money for the province to commit 40%, and I still don't understand how the people are going to pay back this amount of money over time. Even though there's guidelines around it, it's still like, it kind of reminds me back to the BC down payment assistance program, which in my opinion would probably be the best program to bring back at this point. Help people that are first time buyers that qualify get the down payment they need to qualify, and either eliminate or reduce the stress test for them if they take certain terms. To me, that would be a better use, so then people can pick their own options, but this is what it is. So the eligibility is depending on what someone buys, but get this, so it's net assets below 150,000 or up to 131,000 for a studio or 1 bedroom, 2 bedrooms. 191 annually is the max, and net assets below $250,000. You must have lived in BC for at least 2 years, 24 months, and they must not own a property anywhere else in the world. As long as you qualify for that, you're good to go. They're going to push really hard against pre-sales too. So basically, like, as you know, pre-sale flipping, that is. So as you know, a lot of people tend to buy pre-sales and flip them before closing to try and make some money in appreciation. This is why we've seen people unable to close in a lot of different cities throughout Canada, namely Toronto is facing a major crisis. Some areas of BC are going through some challenges, but they put restrictions on that. If you flip it, you can't make the profit. It goes right back to the developer, and the developer resells at the same price. The resale restrictions, if someone sells in the first year, they get none of the appreciation, 20% in the second year, and 40% of the appreciation in the third year. So that's, I suppose, how the government's going to start pulling back or getting money out of the appreciation. And this is just the province and the government admitting that there is going to be continued appreciation. So for all those that are thinking that property values are going down, well, the government is literally betting on property values going up. So, think about whatever that says there about property values if you think the market's going to crash. So I mean, listen, the market is the Vancouver, I guess, City Council and the province of BC is looking for creative opportunities. And on one hand, like I commend them for looking for ways to get people into the marketplace, specifically like quote unquote low or middle income earners who might be able to buy a home in, areas like Langley or Surrey or places like Abbotsford. But on the other hand, I feel like it's too limiting for people, and it's only for first time buyers as well, which I obviously am happy to see first time buyers get in the market. But I do think that's kind of a limited consideration, and we should be looking at more than just first time buyers getting into the marketplace. I think it's a win that the First Nations was willing to jump in and be a part of this. But I see a lot of problems that haven't been quoted in this article, and potential challenges and issues, not only when it comes to future resale value and selling, but also just genuinely speaking by the people who are purchasing these properties. Not to say anything negative of first-time buyers at all, but just the level of experience. What's the management look like? What are these units going to look like? How fast are they going to go up? Et cetera, et cetera, et cetera, et cetera. But it'll be curious to see if these go up quickly and everything happens very fast. Maybe the city has to really seriously consider all that red tape they put on developers and builders that are trying to build other properties out there as well. Last but not least, let's come back to the CMHC rules and guidelines. Now we're coming on September, just the end of September, early October when you're listening to this episode right now. I got to say the one biggest thing that most people are missing about the CMHC rule changes, about these $1.5 million, the 30-year amortizations, besides the fact that you could always do 30-year amortizations with more than 20% down, is the dates. None of this comes up into effect until after December 14th. So December 15th is the first day people can submit for this. So it'll be curious to know if that means that the market, I don't know if takes off is the right word, but picks up right around Christmas time when we're all trying to take a vacation and the lenders are all half off, or right around the beginning of the new year. I've seen a lot of projections, a lot of predictions from a variety of different real estate publications, from some of the economists, about between the rates going down anywhere between 0.5% to 1%, depending on which bank you're looking at, with these new rules coming into effect, with construction lagging across the country, that we're going to see a significant amount of buyer demand in the next 6 months at this point right now. Now, you may think I'm trying to push, property values and real estate, and yeah, you can think whatever you want. I don't really care. But the truth is, all of these things together are colliding to basically create a perfect storm for real estate values to start coming back up in some capacity. And so, the truth is, we still have such a limited supply for the amount of humans and people that are in our country, growing up in our country, going to be buying in our country, and who have moved to our country in the last couple of years, that we're going to have some issues. We're going to have some challenges going to come up. Prices are going to eventually go. It's just a matter of how much and what does that look like in the near term. So anyways, would love to hear your feedback on all this. Drop those comments, hit that subscribe button if you're on YouTube. If you're listening on Spotify, follow me on Instagram. I am at The Mortgage Pug or at Flow Mortgage Co. You can hit me up on either one. I'd love to hear from you. Send me a note if you're listening to the podcast, and leave a review. Thank you, everybody, for watching. I'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.